Well, I'm relieved that BMO was similar to my forecast, so I didn't have to rebuff anything as I came up. Our long-term forecast is around $30,000 a ton after 2030. I thought as a focus for this presentation to do a discussion around why the structural deficit is here to stay, because you've had some recent broker reports suggesting that the world's going to end for lithium. We think they're wrong. A number of other guys who've spent many years in the industry agree the same, so I'll go through the logic. If you want to follow up beyond this, our business is RK Equity. My partner and I consult to a number of pre-production and production companies in the industry, a large number of them. We also do nickel and graphite, but lithium is our speciality. We've been in the industry as a company for 15 years. And if you go onto RK Equity, we have some research on there, and we have a linked YouTube channel, Rockstock, which I'll do a deeper dissection on the Goldman's report and some of the others in the near future. So the issue around why the structural deficit is here to stay is you never see brokers pass out their supply and demand numbers into battery grade and non-battery grade, and in the end, what is the future of lithium? The future of lithium is battery grade. And if you look at it on that basis, that is in structural deficit. At the moment, incumbents have no working inventory left. They sold out, so the net market balance is defined by current supply and demand and recycling. There is no more back inventory for them to draw down on. If you look at what is battery grade demand is cathode production. If it goes in a cathode, it's got to come from somewhere. What battery cells are or installed batteries is the incorrect data point to look at. You need to look at cathode production, and now, as I say, with no inventory, that means supply has to meet cathode demand. Cathode production typically looks 6 months forward. If you are doing a production batch in September now, it's for March next year. So your second half cathode production this year is the first half of ED demand. So that's a greater number than if you just look at current battery cells and multiply some kind of a lithium intensity ratio. And you also, in cathode production, it includes scrappage, inventory build, all sorts of things, battery replacement that isn't current year EV cells. So you find that that's a much higher number. If you consider that EV cells are looking to be 50% higher this year and probably 35 to 40% higher next year, that translates into a major demand difference if you look at demand based on cathode, not on sales. When we look at supply, there are no projects in the world ahead of schedule. At best, they're running on schedule, and probably a good example of that is SQM, and that's brownfield. Greenfield projects will take longer, full stop. And if you look at everyone's models, the percentage of new supply coming from greenfield is growing substantially, which means delays will be inevitable. And the amount of unproven flow sheets where there is no current production, the percentage of those projects as a percentage of greenfield supply is also growing. So that's an added risk. In our opinion, can you include an unfunded and unpermitted project yet to start construction and future supply estimates? We say no. Until it's got what it needs, it doesn't yet include it. You've got chemical production predominantly in China, but demand is growing globally. So if Europe and the US want localized supply chains, will that slow supply growth down if they are now going to have to do upstream and downstream chemical processing in their own areas? Without a doubt, it will. Permitting, construction, all of those things takes longer. So if you look at the surge in EV demand, it's also difficult for cathode manufacturers to qualify new material. So we expect, given the amount of greenfield projects coming online, your average market qualification timelines will increase. A greenfield project, you've got to assume at least 12 to 24 months for qualification. So something that comes on stream this year probably won't be qualified until 24. That's a reality. So when we look at aggregate net supply of lithium versus battery grade net supply, you get to the point of why we're seeing conflict in the market between brokers and ourselves and other industry guys that follow this closely. Aggregate can be in slight oversupply, but in battery grade supply, given the reasons that I've just given, is in deficit, and that's likely to change. We do use a narrow definition, as I say, and of course, further on in these later years, you can fix that. Now you can alleviate the shortfall post 2025, but you're going to need substantial upstream investment. I see a lot of offtake contracts with no money, and a lot of these ones you read as binding or non-binding, because if the material doesn't qualify, it doesn't get sold. So you can turn it around, but we're going to need to see massive investment, and you need to see permitting. And that still remains challenging in certain areas. In Australia, I think, is good for permitting. Canada, I think we're going to start getting there. You've seen critical elements get permitted, and I think some others are going to come on stream as well. Brazil, Africa, but there's still areas that it's going to be tough. And in Europe and the US, it remains a challenge. So that could delay new supply coming online as well. So why the difference? As I mentioned, supply doesn't equal battery grade supply. The timelines, the other thing that one needs to factor in as well is that there are a lot of large-scale new battery plants coming online in the next few years, and typically, especially in the high nickel cathode variants, production scrappage defective cells is high in the initial year or two. So when you look at how much cathode you need and how much of it's going to end up in a heap and having to go back through to recycling or reprocessing, that's going to increase. The other thing that I often see that's a mistake is if somebody produces non-battery grade material and that gets transferred to China and reprocessed, that's not 2 tons of supply, it's 1. But people double count all the time because it comes from different regions. So that also is something to flag. And the other thing is, if you look, all of these issues exist before we get into the whole ESG carbon footprint. I don't know how that's going to go. Nickel from Indonesia, does that need to be cleaner? You look at the carbon footprint, in China, will they adjust? Will they clean? At the moment, people seem to have a free run, but will that change in time? And will logistics improve as well? So if you look at global EV sales for 2022, we've had our first million unit month in September. October, I understand, is about 930, but still well up on last year. And given that January to April had quite a lot of impact with China COVID lockdowns, and we still see some of that, if EV sales exceed 10 million units in 2022 based on our available supply-demand model, we believe that will cause a drawdown on supply chain inventories right the way through, so more pressure in the system. The only way we can see this market leveling, and Roy just mentioned it now, is some kind of demand destruction, but at the moment we're not seeing that in waiting times and in demand for global EVs, and this year looks to end strongly as well. Another thing that was highlighted to me, I've often mentioned, but I saw some very encouraging numbers last week, was energy storage. That, I think, is going to be up 100% this year. If you look at what percentage of global capacity additions by technology, that's Bloomberg. If you look at the yellow, which is solar, the light blue, which is wind and hydro, that's massive additions, and that typically is where you see the ESS solar paired and wind paired. So according to Row Motion and their presentations, they reckon that ESS can be the equivalent of 20% of the EV market in demand by 2025. Will sodium ion take a bit of that away? Yes, I guess it will, but ultimately it's a massive total addressable market, and I don't think you can underestimate it, and the broker reports I'm seeing are So that is an area also to keep an eye on. So where the bearish analysts are getting it wrong, in my opinion, is if you take cathode production, the lithium demand from cathode production, and you adjust it for future EV demand, as I say, they produce 6 months in advance, and you take away battery production scrappage and replacements, etc., and you adjust supply for battery grade qualification delays, there's far less restocking of inventory that's going on in the system that people are claiming. The market is much tighter. If you look at the Pilbara auction prices and the resilient China spot prices, they reflect something different. We're not seeing it move. The underestimating of energy storage. And then if you look at the new internal combustion engine vehicle sale bans that are likely to happen in major auto markets by 2030, 2035, we believe that'll drive an earlier shift into EVs, because the market for second-hand ICE vehicles will either shrink due to high maintenance costs or lower resale values. So it's likely to pull the EV shift forward. This is the Pilbara BMX auction. This is where they sell 5.5% material. It's not even that great out of on a Port Hedland free on board basis. If you look there, first one in July last year, and now look at the 16th of November, a new record that converts into 8,575 a ton on an SC6 CIF China basis. So another record. If you put that through the model and you look at a VAT inclusive price in China for spot, that's $80,000 a ton with zero converter margin. So there, in my opinion, is no room for price decreases in China based on those metrics, whoever's buying that at any rate. So they only get it next month, so they must have confidence that the market's going to hold up, or they are short on delivery under contract. But the reality is another 10% up between October and November, despite all the the suggestions of a cutback. So what are the conclusions? We said earlier in the year that if EV sales go back under 800,000, above 800,000 units a month, that we would test a new high. It's now hit 1 million. We are at record highs around 600,000 renminbi. The auction prices of the BMX highlight tight operating margins, so I just don't see price moves. That will change over time as new material comes on, but they really are short for margin at the moment. If you look at how much is being invested downstream beyond chemical processing, and even into the cathode market, the cell market, and the EV platforms, the amount is substantial. So we believe that it can absorb increased lithium production, provided there's EV demand, to take it on. Incumbent producers need to stock inventory, so even if there's a slight oversupply or some glitch in the system, they will most likely take the material on which they need. We continue to feel that the quickest route to market is spodumene to spare Chinese conversion capacity that already exists. You're seeing MinRes do the deal where they are also doing a tolling arrangement now with their Mount Marion material, so they are keeping some of the downstream margin. China brines are seasonal. It's always been a difficult market. The question also remains how much of that is battery grade. It often has to be reprocessed. Lepidolite, regardless of what people tell you, is challenging. It requires 20 tons versus about 7 to produce chemicals. The material is tough. We've seen even some of the mainstream China players pull out of the lepidolite market. So I have it in my models. I just don't have it very aggressive. And then late stage conventional brines ex-China will also, Argentina, despite difficulties, remains open for business. If it is late stage, it will be in high demand. We think M&A is going to continue. We've had quite a bit in 22. I think through 23, as the disappointments and timelines of new supply push out, there is no other choice. You've got to step in and find what you can get. So the other thing is, if you look through the list, I think some of the OEM and battery cell guys have done a clever thing with doing off-takes, because they've committed no money and they've tied up companies. So if you can find a company that hasn't committed to offtake and will be in production by 2025, and it's on a conventional flow sheet. We think that's the main target areas. I think we're going to see JV and M&A activity there. If you look, lithium is now the largest raw material cost in an NMC 622 battery. So we believe the cell companies, and in particular the South Koreans, we think they're light on material, will be forced into M&A and upstream deals. And it's not just a case of getting the supply, it's also a good route. There can be arbitrage in terms of funding costs and so on to get a lower price and future supply. So that's a snapshot. As I say, if you want to see more, go on to rkequity.com and the Rockstock channel. We do videos with companies in the sector and with other industry experts, and I will be doing more of a dissection on the Goldman Sachs report that's come out that's caused a bit of a blip in the market recently. That's it. Thanks very much.